Stock market have started a healthy consolidation beginning of February. It's coming after an exceptionally good month of January, and so it's welcome. From a technical point of view, the situation was very overbought, and so the current consolidation deflates this overbought situation, which is, as I will explain, healthy. We remain relatively cautious for the short term. We expect this consolidation to continue somewhat. This is from a technical point of view. For the longer term, we stick to the positive view concerning risky assets. We think that we will make new highs this year thanks to three elements. One, economic growth is solid, it is synchronized, and it will continue to help corporations to deliver increasing cash flows. Secondly, we expect a tightening of monetary conditions, but this tightening will be moderate from an historical point of view. Thirdly, equity markets are relative to yields relatively cheap. Equity markets from a valuation point of view are relatively cheap, especially compared to bond yields. So we are sticking to our long-term optimism concerning risky asset prices. This consolidation in equity markets came because of the tightening of financial conditions, rising interest rates. And indeed, for the first time in 3 years, we are upgrading our targets in terms of fixed income yields. Economic data have been excellent in the US. For the first time, we are beginning to see an acceleration in wage increases. That's the first element. Secondly, the weak dollar implies that imported prices will be on the rise. And thirdly, the fiscal stimulus package that the Trump administration is implementing arrives at full employment currently in the US. So inflationary pressures are increasing, which means that the Fed is going to tighten more than expected. So the Fed will hike 5 times by 25 bips instead of 3 times which we were expecting before, which means that the Fed will do 4 times in 2018 and 1 more time next year. It's 50 bips above our previous estimate, and this is also those 50 bips that we are increasing in terms of 10-year yields target, meaning that the 10-year yield in the US will go to 3.25 instead of 2.75 we had as a target before. In Europe, economic data were also excellent. Nevertheless, the ECB does not have the same inflationary pressures to fight. In fact, wages are well under control and imported prices are not going to rise tremendously because thanks to the strong euro. So we keep unchanged our hypothesis for the ECB. The monetary policy will stay accommodative. Guidance will probably be changed in March. Preparing the tapering starting in September for the end of quantitative easing by the end of this year. But we do not expect any interest rate increase by the ECB before well into 2019. For bond yields, the American yields going up will have an implication on European yields. And indeed, we expect bond yields in Europe to go higher. So for the Bund, our target is 1.25 versus 1% previously because of the correlation on a global basis on the bond markets. Nevertheless, overall, the normalization of monetary policies will be relatively slow. In the US, even if it's accelerating somewhat, it is historically a slow process, and bond yields will continue to be historically low, especially compared to inflation. Thank you for your attention.